This slide explains what is capital asset pricing model. So as you can see, this equation Ri means stock's required return. Yeah, it can be used as a discount rate when you value a stock, right? And there's a risk-free return, right? Risk-free return here, right? And plus risk premium that reflects stock's risk after diversification. So that is this part, market risk premium, right? Risk premium is here. And what is beta I? The beta I shows the stock I's risk premium, and it is a relationship between what? The market and individual stock. So beta measures a stock's contribution to market risk. From this equation, what is market risk? At this part, right? This part is market risk. When the beta is high, it means it contributes more about this market risk, and investors require more return about this individual stock. Can beta be negative? Yes. If the correlation between stock I and market is negative, we can have negative beta. For example, the low is less than 0. As you can see, the collection agency's expected return move opposite way with the market, right? So market goes up, collection agent expected return goes down, right? And market goes down, collection agency expected return goes up. So it is opposite way. In this case, collection agency can have negative beta. But in the real world, the negative beta is difficult to find in the real world. So it's very rare case. It shows how to calculate betas. So well diversified investors are primarily concerned with how a stock is expected to move in the future. So at the previous the equation CAPM RI RRF, so that is not a market. In this case, expected market return minus RRF multiply beta, right? But without a crystal ball to predict the future, analysts are forced to rely on historical data. So we can see only the future, only the past, not the future. So a typical approach to estimate the beta is to run a regression of the security's past returns. So securities past return, RI, and past returns of the market. Past returns of the market. It is RM. And the slope of the regression line is defined as the beta coefficient for the security. Right, we have the historical return of the market, the 3 point, and individual stocks return. And x-axis is RM, market return, and y-axis is this individual stocks return. And firstly, you dot the returns. For example, the month 1 is RM is 15, RI is 18 here, right? So this is the month 1. And the second one is minus 5 and minus 10 here, right? It's month 2. And last one is month 3. In the OLS, when you regress this equation, the beta can be calculated by this way. The covariance of Rm and Ri, and denominator is variance of Rm, and we can write this rho Rm Ri sigma Rm sigma Ri, and denominator is variance of Rm, right? And we can rewrite rho Rm Ri is sigma Ri over sigma Rm, right? So the important part is here. What does it mean? The correlation between Rm and Rri. So if this has positive, the slope will be positive, right? It has positive beta. And opposite case, it has a negative, slope will be negative, right? You don't have to know this in this class because we can search in the web, in the real world. This is Yahoo Finance. So for example, I input the Apple case. Apple, this is stock price, and there is beta, the 5-year monthly beta. It is more than 1, right? It means what? If, for example, market increase 10%, the average stock price increase more than 10%, right? This slide shows the beta coefficient for high-tech company, collection agency, and T-bills. High-tech company is similar with Apple case. It has higher than 1, right? So it means if the market goes up, the high-tech company stock price increases a lot, right? It means high-tech company is very sensitive to the market. What about the opposite case? The collection agency. Collection agency, the beta is negative, right? So when the market goes up, collection agent's expected return goes down, right? And market goes down. When the market goes down, the collection agent's expected return goes up. It moves opposite way. So the beta has negative. What about T-bill? What is T-bill? T-bill represents risk-free asset. It has same return even though market change, right? So beta has the 0 number. So the comparing expected returns and beta coefficients, as we learned before, there is one fundamental relationship between two, the risk and return. High risk means high expected return, right? So in this case, the risk measure is what? Yeah, in stock, we can construct a portfolio. So the good risk measure is function of what? Function of the beta, right? So as you can see, when beta goes up, it means risk goes up, the expected rate of return goes up, right? There is a 1-to-1 relationship. So riskier securities have a higher return, so the rank order is okay, right? So the CAPM, this equation, we also call the security market line. And from the earlier slide, the RM subtract risk-free rate is here, right? RM is market portfolio 10.5% and risk-free rate is 5.5%, right? So you input the numbers 10.5%, this is 5.5%. So finally the market risk premium is here, right? 5%. Learn more detail about this market risk premium. What is the market risk premium? It is additional return over the risk-free rate needed to compensate the investors. So each size depends on the perceived risk of the stock market and investors' degree of risk aversion. So it varies from year to year, but most estimates suggest that it ranges between 3.5% and 5% per year. Security market line, we can calculate required rate of return, right? The security market line RS, required rate of return, can be calculated by RRF plus RM minus RRF multiply the beta, right? And it can rewrite as this: market risk premium multiply beta, right? So high-tech company case, what is RRF? Yeah, we already calculate here, right? 5.5%. It is about the risk-free asset, the TB rate. So 5.5. What is market risk premium? It is here, right? 5%. So 5% multiply beta. Beta is here, right? So you input the numbers 1.31, that is 12.1%, and repeat this process. Five percent multiply 1, 10.5%, 5% multiply 0.1, 9%, and 5% multiply 0, right? Yeah, beta is 0, so 5.5%. And collection agency, 5% multiply, it has negative number, right? Negative 0.87. Finally you get 1.2%, right? As you can see, the collection agency, the required rate of return is lower than risk-free rate. Why? Because it provides a hedge with general market. So they move opposite side with most securities. So we can use collection agency as a hedge. It can diversify the risk and evaluate which stock is overvalued or undervalued. As we learned before in this slide, the expected rate of return higher than required rate of return, we say this stock is undervalued, so we should buy, right? Because we can have some benefit. The opposite case, if the investor requires this amount, but they can expect the rest return, in this case, they should sell or not to buy, right? Right, the high-tech company's expected return is here, and we already calculated using this formula, right? High-tech company's expected rate of return is here, right? And what about the required return? Required return can be calculated by using CAPM model, right? So, and we also call that the security market line. So using security market line, high-tech companies' required rate of return is here, 12.1. So expected rate of return is higher than required rate of return. So this stock is undervalued, right? The opposite case, the collection agency required rate of return is 1.2, but they can expect only 1%. So this stock is overvalued. And this relationship also expressed using security market line. This is the security market line, and security market line can be expressed as this: RRI is equal to risk-free rate plus market risk premium and individual stocks beta, right? And what about high-tech company? It is above the SML line. It means undervalued stock. What about this collection agency? It is below the SML line, so we can say this is overvalued stock. What about T-bill? It is the same with SML, right? So we can say it is fairly valued. One thing you should know is when you're illustrating the security market line, the x-axis represents beta, not a market return. Okay? Important thing regarding SML, security market line, the slope. What does slope mean of the SML? The slope means the beta. Beta is here, right? That is one more important part when you're illustrating security market line. So as we learned before, we can buy 2 and more stock. So the most important concept is beta of the portfolio. How to calculate the beta of portfolio? Okay, for example, if we create a portfolio with 50% invest in HT, high-tech company, and 50% invest in collection agency. The beta of the portfolio is weighted average of each of the stocks betas. Weight 50% multiply beta of high-tech company. We already get this right. High-tech company's beta is 1.31. So 1.31, and weight of collection agency 0.5 multiply the beta of the collection agency. Here, right? Yeah. Collection agency's beta is minus 0.87. So write down minus 0.87, and finally you get the portfolio beta, that is 0.22. Now we want to calculate portfolio's required return. As you can see, required return can be calculated by CAPM. And there's one more method to calculate required return of this portfolio. I want to calculate this one first because we already know all these numbers. What is RRF and RPM? The risk-free rate and market risk premium, right? It is here, here, and here, right? So you input the numbers 5.5%, and market risk premium is 5%. And we already calculated portfolio beta at the previous slide. Here, right? So you input the numbers. Finally, you get required rate of return of this stock, 0.066. Also calculate using weighted average of each of the stocks required return. So the WT is 50%, so 0.5 multiply RHT. RHT we already calculated using this slide, right? RHT is 12.1%. So you write down that equation, that number, and 0.5 multiply this number, right? Yeah, our required rate of return of collection agency is 1.2%. So input the number 1.2%, you get the same result of this. The two factors that change the security market line. The security market line can be written as this. Ri is RRF plus market risk premium multiply the beta, right? And this RRF can be decomposed two parts, right? Real risk premium and IP, inflation premium. So when the inflation increase, this moves up, right? And also this moves up. What is happen? In this case, the intercept moves up, right? And the second factors that will change the security market line is the risk premium of the market. So it is about here, the security market line. We can write RI, RRF, market risk premium multiply beta, right? And market risk premium is market return subtract by risk-free asset. In this case, investors' risk aversion increased, right? Causing market risk premium to increase by 3%. It means if there is more risk, investors want to compensate for the risk, right? So required rate of return increase. So it reflects here. Then what would happen to the SML? As we learned before, the slope of SML is what? The slope is market risk premium, right? So market risk premium change, it means the slope change. So in this case, slope moves up, right? There is some sort on CAPM. In CAPM, we can write as this: RI is equal to RRF plus market return minus risk-free rate multiply beta, right? Actually, this equation is this: expected market return minus RRF power beta, right? So this concept is what? Yeah, actually we want to know the future return. In this case, we should input the future market return. But who knows the future? Yeah, as we mentioned before, we don't have any some sort on CAPM. CAPM cannot be verified because as we learned before, CAPM equation is here. Right? And actually, the investor want to know the future return, right? So the future expected RI minus RRF, expected RM minus RRF multiply beta, right? So we need this, right? But as we learned before, we don't have any crystal ball, so we cannot predict the future, right? So without a crystal ball, we can force to rely on historical data. Explain again. Yeah, CAPM concepts are based upon expectations. So here, right? But we don't have the crystal ball, so we can know the future return, right? So betas are calculated using historical data, and the historical data may not reflect investors' expectations about future riskiness. So we cannot verify the CAPM is right or not. In addition, there are some argue that there are additional risk factors other than the market risk premium that must be considered. For example, the additional risk factor is the size, and book to market ratio also can be considered as a risk factors. The Palmer French they suggest a three-factor model: the market risk premium, and size, and book to market ratio, and they explain how these risk premiums can affect required rate of return. And they got Nobel Prize 2013. So if you still interested in finance after this course, you can learn this part in the investment course. So far, we learned the investor perspective. The second half of this course, we will look at corporation perspective. So when issuing bond and stock, who provide the required rate of return? The issuing company, right? So as a corporation perspective, the RD, and RS, the required rate of return on debt and required return on stock, these two are the cost, right? The cost of debt and cost and stock. And this cost of capital should be less than return on investment, right? So we will learn how the corporation make investment decision and how corporation raise your money, raise your capital. So what is optimal capital structure for the firm? And the rest part is how corporation distribute to the shareholders. Thank you.